Let's continue that story, bringing you some domestic analysis. Jim Stening from FIIG Securities in Sydney. Jim, a warm welcome to you. What did you make of, I guess, the tone of that statement, both towards treasuries and equities? You know, the response from both those markets was quite telling.
Yeah, look, I think so. I mean, one of the things that I think it's important to note is that when Bernanke speaks, obviously every syllable is watched closely, and to sort of diverge from what he's been saying historically would have a significant impact in the marketplace. And it's interesting when you look at, say, his lieutenants on the FOMC. You know, they're quite free. They luxuriate in the ability to speak freely about their opinions on you know, where monetary policy or where stimulus should be withdrawn or continued. So I think one of the important things for me is looking at that debate that's going on in the background. There does seem to be some momentum swinging towards the removal of stimulus, so the pressure is certainly on there.
Although one analyst is saying, look, he'll continue to see that glass as half empty as a means to keep market expectations for that exit strategy as a later rather than sooner development. It is going to happen, but not just quite yet. Yeah,
look, it's really interesting for me though. I mean, if you take the view that QE2 is the last of that type of stimulus, well clearly that's already begun and it's well progressed. For me, that's the bookend. I mean, that stimulus will not be ongoing once it's completed. So that really is only 3 or 4 months away, and I think perhaps that's something that the market's not really focusing on at the moment.
And if by that point, though, the jobs turnaround hasn't occurred, how can Bernanke, I guess, sit out there and say, I succeeded?
Well, I guess that's, you know, there are risks, I suppose, but there is some mounting evidence, and I think Bernanke alluded to that, you know, in his address today, that the economy is repairing, and traditionally those numbers like employment are really lag indicators. That we are seeing some positive numbers coming through, albeit, you know, not extremely positive. So there should be momentum developing there. I think, you know, the interesting thing is though that you know, that 3 or 4 months before this actual QE2 concludes, I mean, that could very much coincide with that turnaround.
Do you think he's feeling the pressure from the Treasury markets at all, you know, the bond vigilante types?
Well, look, I mean, I think you know, as I said, I think one of the interesting things about the US bond market, we're seeing this massive sort of steepening in the curve, notwithstanding the pressure on the end of that curve from their ongoing buying. So I don't think that the bond market is a real believer in you know, deflation or in the continuation or in an economy that's not growing.
That's the thing, though. We've got to remember that when we talk about bond vigilantes, what we're really talking about is people not buying bonds. But the latest round of auctions has been a success. So if anything, what is that telling you, Jim?
Well, I think it's been a success because we've had such an incredible pop in rates. I mean, you know, we've seen rates move up substantially from where they were in the December quarter, so they are starting to be attractive to move out on the curve. We're certainly seeing that.
Jim, what's your view on the Bank of England meeting tonight as well? There's only about a 20% chance of a hike being priced in, but do you see any greater risk than that at this stage? The credibility of the BOE is being questioned. Do you think it might come out to say, look, we're onto this, and here's a rate hike to show it?
Well, yeah, look, I mean, I don't think so. I mean, I think there's the market. Who am I to argue with the market's 20%? I think that's probably realistic. But also, I don't think there's any economists expecting a tightening from King today or in the next 24 hours. I think also, you know, I suppose it does send a signal, but it's a really powerful signal, and I suppose 0.25%, whether that has any material impact going forward, you know, it needs to coincide with changes in the underlying economy.
What has this round of reports domestically done so far? We continue to get the trickle of them, even for viewers across the screen at the moment, doing to, you know, the belief that corporates are going to need to tap the bond market domestically. Is there a follow-through from numbers you've been seeing to the next step, which is, you know, a round of issuance?
Look, I think so. I think, you know, if this equity rallies to be believed, I think that what we can expect to see is you know, compression of credit spreads over the next 3 to 6 months, and I suppose that is going to make issuance of debt in the capital market an attractive proposition for corporates. I think it also has implications for banks raising rates out of step with the Reserve Bank. Obviously, that would be a lot less likely.
Do you think the results from, I don't know if you got a chance to look through the results themselves from CBA, but they even gave it a higher dividend. It doesn't seem that the pressure on the margins maybe is as bad as they might have been suggesting?
No, well, that's right. But I mean, I do think that there is ongoing pressure. There is still cheap debt maturing. But I do think that again, I'm not absolutely convinced about this equity rally. But if it does play out, we are going to see those corporate credit spreads, or the cost of borrowing, particularly to banks, come down. So that will be a mitigating factor.
All right, looking ahead then, Jim, for the next catalyst to key off, I guess we've got the jobs print today domestically, much the same as tonight. We're going to be getting another snapshot from the US on that front. How are you seeing the two markets diverging there, just in terms of, I guess, productivity?
Well, I'm not sure what you mean by productivity in terms of unemployment. I think unemployment in Australia. I mean, obviously, there's been some real performance there. A continuation of that trend seems to be what's expected. How that plays into bond markets, I think, what's affecting bond markets at the moment is the inflation story. I think domestically we're well insulated, or we seem to have been well insulated from an appreciating currency. And I suppose in the US, whilst they've got low levels of core inflation and headline inflation, there are some serious threats emerging down the track there. So I think that what we're going to continue to see over the next 3 to 6 months here is a compression in Aussie-US bond spreads.
If we have been well insulated with that inflation being contained, can we therefore cope with another rate rise? I mean, we can presumably absorb one in May.
Domestically, look, I think a rate rise, rate rises have been reasonably destructive timing-wise. We've got an economy moving into probably a negative quarter. So to me, that doesn't seem likely. What we may have, if this equity rally plays out, is this, as I said, this compression in credit spreads, which in effect does put more upward pressure on official rates.
That jobs figure today, how much does that come into play for the RBA in coming months in deciding of the timing, perhaps, of the next hike?
Yeah, I think really, with the disasters in Queensland and Victoria and the drag that's going to have on growth, really these sort of one-off indicators are not going to impact greatly either way, I think, in their thinking.
What's been the situation with FIIG, incidentally, Jim, in Brisbane? Where are you at with operations? Just give us a sense of update.
We're fully back up and running. I think there's still some sludge in the 4th level of the basement car park. So, interestingly, all the car parks, I think, in Eagle Street are still out of action.
All right, so you're covered a number one space, perhaps offline for a little bit longer, Jim. We'll stay put in Sydney. We like seeing you here for now. Many thanks.
Thanks, Carson. Thanks, Brooke.
Jim Stening there from FIIG Securities.